You're absolutely desperate to make it as a day trader. You recognize the benefits it could bring to your life. More freedom, more control, and best of all, more income than you could ever dream of. The problem is, no matter what you try, you keep failing. You're not getting the results you want. You're desperately hoping the next video on YouTube shows you the perfect indicator combination that's going to be the answer to all your problems, right? Wrong, wrong, wrong. Have you ever wondered maybe you're looking in all the wrong places? Now today, I'm going to show you exactly the type of analysis we were doing when I worked at one of the top investment banks in the world. The crazy thing is, anyone can do it. You just need to stop wasting time on stuff that is never going to bring you success and start looking at the right stuff. And that's what we're doing together today. Okay, ladies and gentlemen, so that was quite a bold opening, but hopefully you can see I'm actually backing it up with stuff you might have never seen before. You really got to broaden the scope of what you're looking at if you want the best results. You can see I've laid things out here very differently to how you might have been used to seeing them. Looking at the whole environment as a whole, like I said, broadening the scope of what you're looking at what's been impacting the market in a negative way, in a positive way, and trying to really find the balance and where the trading opportunities may be. So don't worry, we're going to go through all of this together, okay? And it's not just some news chatter, okay? If you look at my last video, not now, do it later, I'll put the link right at the end, you'll see my results. They're up there with the very best, so this stuff actually does realize and turn into monetary gains. The point is, you need to be actually putting in the work first. But we're going to do that together, so I'm going to show you exactly how to do that. But first, no point getting straight into this. It won't take more than 10-15 minutes, but the point is we need to set the scene first. So that's what I want to do here. What's been going on in the market recently? When I say the market, I'm talking about the equity market, but this applies to every market. As you'll know if you've watched any of my videos before, the last time I did an institutional weekly, we had a lot of negative sentiment going on with the Ukraine-Russia war, which ended up being a great analysis. And I had a fantastic February, March using a lot of that analysis. Things changed recently in the last few weeks. We had a 10% rally as the market just kind of recovered from that heavy negative sentiment that we had in February, March. And now we seem to be getting a little bit more on the negative side this week. And that's what I want to talk about and really put things into perspective and kind of ask the question, will the negative sentiment continue going forward? And that's really important because we need to know how to position ourselves, long side, downside, sideways, and these things are really what's driving institutional investors to push the market one way or the other. So let's really have a look and think about which way the market is likely to go, not only next week but in the coming week. So let's really break down all the stuff that you saw here, but also set the scene, so which you see here. Now just quickly, looks like a whole bunch of lines, but actually very, very meaningful in the sense that they pretty much cover every asset class you could ever imagine. So commodities, cryptocurrencies with Bitcoin, which is the purple line, equities, commodities I said already, with crude oil, the red line, FX, okay, so you've got pound yen, dollar yen, and then the treasury rate. Now, if you've ever watched me talk about these before, you've noticed that the markets have been heavily correlated, right? We can see that up until last week. Bitcoin going down, equity markets going down, yield curve, the yield rates going down, crude oil going down, FX going down. So it didn't matter what market you traded, you had to follow the general sentiment to really understand your particular market. Okay, now look at what has happened. Very, very interesting and really something, if you're not on top of this, you really need to start getting on top of it, okay? But that's what we're here for today. Look at this disparity that's been going on recently between the FX market, treasury rates in particular of interest, and the equity market, Bitcoin and crude oil. So you can see the equity market, energy markets, and Bitcoin have been very negative. They're being driven by this rise in rates. The market has been spooked by the yield going up. So that's something that I want to be focusing on today, because that's what we've seen the whole of last week. Have you been following the market last week? And I don't mean this in a rude way. you got to forget about all those random squiggly lines on your chart. They're completely meaningless. That's not what's driving the market, okay? The stuff that's been driving the market is this order flow, which I talk a lot about in other videos, obviously you can check out, but also the backdrop. This is why the market has been feeling fairly negative over the last week. So let's zone in now, right? Let's really zoom in to this area over the last week and talk about some of this negative sentiment. Like I said, if you're not aware of this, then what market are you trading? You're definitely not trading financial markets, right? You need to be aware of what drove the market, right? I mean, if you're trading something, you need to be aware of it. Again, it's not a criticism, we're gonna do it this week so you can start to think about these things going forward. You can see here, really the negativity started on Tuesday, right? So minus 1.26, FOMC committee member said something very, very hawkish in terms of, being aggressive. When I say hawkish, I mean, that may result in policy getting tighter. So, interest rates going up or the balance sheet essentially being reduced. And we'll talk about that. FOMC minutes then doubled down on that. So really the market was hammered hard on Tuesday and Wednesday with negative sentiment. And then we had a little bit of a recovery with some jobs numbers, and also the market just kind of taking profit from some of these negative comments that we saw on Tuesday, Wednesday, which really tie in to this. We're seeing yields going up. Why? Because of this negative sentiment. And that's doing what? Driving Bitcoin down. So if you're trading Bitcoin and you're not aware of this, you shouldn't be trading it. Driving equities down, driving crude oil down, because obviously global demand will be affected if rates go up, and also driving the FX market up, things like dollar yen and pound yen. So any of those markets you're trading, FX, commodities, equities, cryptocurrencies, and you're not aware of this, you got to question, where you're at in terms of your financial education cycle, and you really need to start pushing that ahead today. Start today. Now we have got some incredible analysis, and we're going to come back to this economic scorecard, which is fantastic and really going to set the scene for the next month. So you can print this out, have this in front of you, because it is going to be driving markets not only next week but for a few weeks. But I just want to talk a little bit about what was said on Tuesday and Wednesday, because it is important. So this Fed member, what they basically said was that they expect the committee to start getting much more aggressive on reducing the balance sheet or shrinking the balance sheet, the Fed balance sheet, much more aggressively than during previous recoveries. So that has obviously spooked the market a little bit. On top of that, we then had the FOMC minutes, and I've got it written down here, you'll have to forgive me, I can't remember it word for word, but it basically said that participants generally agreed it would be appropriate to reduce the balance sheet, right? So basically what this member had already said, shrinking of the balance sheet. So what they said is participants, so the FOMC members who vote for all of this to happen, appropriate to reduce the balance sheet by $95 billion per month, 60 billion treasuries, 35 billion MBS, and crucially that one or more 50 basis point hikes would be appropriate at future meetings. So they've said future meetings in the minutes because they don't want to commit obviously to the dates, but more than likely that is going to be the May and June meetings. So end of the day, you can see it was quite a wake-up call for the market that, hey, okay, we know that there's stuff going on around the world, for example the Ukraine-Russia situation, but actually we're more focused on matters at hand such as inflation and given the recent economic backdrop, which we're going to talk about, being fairly positive, so you can see that here, a lot of positive factors there, is giving the Fed room to be much more aggressive than the market had been expecting. And that's good. The Fed liked that because it allowed them to tackle the inflation problem, which we're going to talk about in just a moment. Just quick summary then of last week, and just to put it in kind of a calendar format, we saw that Brainard spoke. There were other committee members talking, but the reason why this was taken really strongly by the markets was because this member is typically quite dovish. Okay, so for this member to now be talking so aggressively about balance sheet contraction, obviously it was taken very seriously by the market. And then the minutes, like we said, and just spoke about. We had claims, an incredibly aggressive claims number, very, very positive number, like I said, which did help the market recover towards the end of the week. However, on a net basis, a negative week, okay, which cut the winning streak. I think we had 3 constant weeks of positive gains for the market, and this has really, put a spanner in the works a little bit and brought us back down to reality. So let's put some of this, what we've been talking about, into pictures so you can really understand why the market is so concerned about the rate rises. There's been a lot of talk about the yield curve inversion. Definitely recommend you go and check that out. So don't really want to get into too much detail because I do want to keep this short, but essentially what that means is, for the first time since the last recession, so just prior to 2020, you can see here the yield curve has inverted, and this has been massive. It's been all over the news. So the 2-year rate, which is essentially right at the front of the yield curve, and did actually get above the 10-year rate just briefly. It's now bounced, and the market has been making a massive meal of this. Well, actually the news outlets have. So actually, what I'm suggesting to you today, and you're going to see that, is I think one of the reasons I've been successful in markets is because I do my own analysis. Even though all the news outlets have been saying, the 2-year rate and the 10-year rate have been inverting, and yields have been going up like crazy. So you can see that here, the 10-year rate is up almost 100 basis points, or 1 whole percentage point this year. And again, we see that a lot of flicking around, but it is important. You see that here. You see it here, the US 10-year Treasury, the green line, very aggressive move. So we have seen that happening, and that's obviously had a negative impact. And we're hearing a lot of this in the news right now about negativity, right? So not only with rate rises, but also with inflation hitting multi-year highs, obviously with the Ukraine-Russia situation. So again, one of the reasons I was saying why they're highlighting this is because in the past, historically, every single recession historically has been preceded by an inversion of the yield curve. So you can see that here. 1980, 81, 90, 2001, 2008, 2020, and who knows, the next recession, it's obviously coming at some time. When's it going to be? 2023, 24, 25, who knows? But it will come. There tends to be a bit of a lag between the yield curve inversion, i.e. rates rising, and the stock market underperforming and a recession coming. So the point is, this time, what I want to say to you is, yes, we've got all this negative sentiment, okay? Inflation, obviously multi-year highs, we've got rate hikes, expected to be, so this is where the FOMC expects rates to be by the end of this year, around 2.25, and I believe in the last few days, even since this chart was put out, that's got even more aggressive. So expecting something like 7 to 8 rate hikes. We just talked about it there, 250 basis points hikes at the next 2 meetings in May and June. So really, and the Ukraine-Russia situation. So you might be arguing, hang on, is there any positive news out here, MV? Well, this is the point. I think investors who don't do well, they follow the crowd. They're very lagging. So they see this type of thing happening where the market is now negative, and they'll try and continue that sentiment. Sometimes it's like appropriate to do that, but I'm here to show you that actually I think outside the box, and I'm thinking to myself, that's probably not going to be the case. Why do I say that? Because firstly, let's think about positionally how the market is, right? So what do I mean by that? What I mean by that is the market, starting this move much further down? Okay, no, it isn't. We're starting right at the top, which suggests to me that some of the sell-off was what? A lot of these guys taking profits. Okay, so there'll be some of that factored in, which when you read the news, it doesn't really take that into account. They're just looking more at the headlines. So a lot of what happened last week, while justified, some of it was just positioning. A lot of the market had got very, very long. We'd had a 10% rally in something like 10 days, crazy move. So a lot of it was positioning, some of the sell-off, but also more importantly, if you actually look at the backdrop, last week, a lot of the focus was here. So look, yield curve, 210 inverting, rates going up, Fed policy getting very, very aggressive. Obviously here we should have put Ukraine, Russia as well. But I think what's going to happen going forward is the market is really going to start focusing more on other factors. These factors, okay, they're there. It's been said now. The market's already digested it this week. But actually the reality is next week we're going to be getting other things coming at the forefront. So things like corporate earnings, okay? Things like the employment situation will obviously come more to the forefront going forward now that we've had a lot of the minutes out of the way, we've had a lot of negativity out of the way. Commodities prices, if you think of crude oil, let's go and have a look at that as well. Very, very mixed picture is the point. Let's go and actually have a look at that. Just give me 1 second. So yeah, let's look at crude oil. If you actually look at crude oil, it's retreated a lot, okay? So a lot of this impact, right, has already happened in terms of the price rises in crude oil. So we expect that to be kind of level off a little bit now, not expecting so much volatility from the energy market. That's probably going to be a positive thing going forward. We've got earnings season starting, Q1 earnings season starting next week. Yes, some of the earning growth is likely to start leveling off because the positive base effects from the past have now gone. However, still very, very positive, right? So positive earnings growth still expected, 5-10% around the 15-year average. We've got CPI next week, which on a headline basis is expected to hit new records. But actually, when you strip out the effect of energy, this energy is actually expected to come off ever so slightly. So that could be a positive surprise for the market. Finally, Ukraine, Russia. Obviously, we all want, the situation to end, but the point is it's becoming more of a mature situation. The shock value is no longer there. It's not a new war. It's been going on now for several weeks, and the market has had time to digest. So it's less likely to have as big an impact as it has in the past. So let's have a look at that again and just quickly summarize this. All right. So on the negative side, you've got Fed policy, you've got the yield curve steepening, you've got commodity prices having risen a lot recently, but now I think the market is really going to start focusing more on things going forward, which is, as I said, corporate earnings, right? Q1 corporate earnings. The ISMs, which we just had this week, services was very, very strong. So as the market kind of puts this in the background, now that it's been able to digest it, what I mean by that is, look, the FOMC minutes have said what the FOMC minutes are going to have said, right? Okay, we're now expecting 250 basis point hikes, but actually, is that going to be a bad thing? No, I think the market will start to realize that actually could be positive for inflation. There was worries about stagflation, but actually, is growth close to zero? No, it isn't. It's very positive. We've got strong employment gains. We've just had historically low jobless claims, which I've just mentioned here. Right, unemployment claims, crazy number, 166,000, so low. Credit spreads as well, which I won't really get into, and then household savings, at a very historically high levels because of COVID. People were able to save, and commodity prices now likely to start to come off a little bit. So I think that initial shock value that the market had from the headlines last week, it's digested it. I think the market is now going to start to really broaden its horizon and start to look at all the factors that matter. So like I've said here, okay. One final thing I want to say is we can actually look back at history. The last time the Fed, started to contract its balance sheet, which is obviously quite an aggressive move to make. It has the equivalent effect of raising interest rates. The last time it did that, right, in mid-2017, right, look at what happened. Stocks actually rose 16% in the first 12 months, okay? So the market is very resilient. The point is, a lot of this effect of Fed tightening, I think the market will start to recognize that it's not going to have a negative impact on what matters, which is what? Growth, households, corporate earnings, corporate credit markets, investor sentiment, employment market. Don't forget, every recession is always started with a negative employment situation. Right now, all of that is positive, right? So nothing is really pointing towards, even if the Fed does decide to get very aggressive, any sort of recession in play. That seems to be still a couple of years away, that this impact of what the Fed's been talking about this week likely to come through. So hopefully that makes sense to you by what I'm saying there. So to summarize, basically what I'm expecting, right, is the market to kind of just level off around here. I don't expect us anytime soon, unless something drastic happens, for us to make a play for these lows. I really don't. I think all the negativity has kind of been priced in now that you see on this side. Even some of the negative stuff you may see start to dissipate. The market will focus a lot on these positives and realize, oh, hold on, this negative impact. Historically, if you look at negative periods for the stock market, all of these things will be on the left-hand side. So, when these things are happening, the impact on these things is negative. Obviously, the market is going to sell off. Now, we're starting from a different base. The economy is very, very strong right now. Even if the Fed raises 250 basis point hikes and does even more than that, what's the likely impact on the economy? It's going to be muted, right? There's a lot of space for the economy to contract before we even start thinking about recessionary environments and so on and so forth. So what we're going to do just finally is just have a look at next week's calendar. I already said about the headline inflation. You can see that expected to be a crazy number, but that includes energy, and we already saw energy starting to dissipate. The core is going to be the key one to look at. We've then got some retail sales. We've also got Q1 earnings. Okay, so do you see? I think there's going to be a lack of negative sentiment there. I think the market will start to focus on some positives next week. I also want you to start thinking if what you're actually doing in your own trading reflects the sort of analysis needed to be successful. So now you see how the pros do it and you want to do the same. However, to really get yourself to this level, you really need to change the way you view trading right from the bottom up. And that's why you should watch this video here next, because I'm going to show you 4 crucial rules I've learned from 20 years of trading that you can implement right away.